You must have all done final accounts questions. A final accounts question of sole proprietary is incomplete without adjustment on sundry debtors. I mean, Sundry Debtors and family. In this family, we have three prominent characters. One, the head of the family, which is Sundry Debtors. Next, the most common character of the family, bad debts. And you also have the most interesting character of the family, provision for bad debts. You do also have some three guest four characters like provision for discount or recovery of bad debts, sometimes provision written off also. And in this discussion, we'll see the entire logic behind this. What is the accounting entry that we should have passed? Where can it appear? What to do when it comes in trial balance? What to do when it comes in adjustment? Why will it come in trial balance sometimes and not come sometimes? And why is it given in adjustment sometimes? And how will this on the whole impact our financial statements, meaning final accounts of sole proprietor? Are you ready? Let's begin. To begin with, who is a sundry debtor? Sorry, who is a Sundry debtor? Sundry debtor is an asset in our balance sheet. He is our customer or she is our customer to whom we've sold goods. And if this customer of ours doesn't give the money to us instantly, they end up becoming Sundry debtor. So, the customer to whom the goods are sold on credit is a Sundry debtor. The customer to whom the goods are sold on credit becomes a Sundari debtor. If this Sundari debtor becomes a bad debt, it's an expense. If this Sundari debtor becomes a bad debt, it's an expense. What is bad debt? This person to whom I have given goods, who owes me money, will tell, oh, hello, I won't give you money. That's very bad, no? He told Ogolo, that person who tells Ogolo, I won't give you money, that guy becomes bad boy, meaning bad debt. Why is bad debt an expense? Very simple. We gave them goods and we've recorded it as receivable and we've also booked income for the goods sold to him, expecting to receive money. Now, when he or she says they won't pay money, then the goods that we gave them originally would be free. We are not receiving money, but we already booked income against it. To reverse that income, we need to book bad debt as an expense. And sometimes, no, people are not bad. We somewhere judge them too much and we feel that they are bad. If my customer says, oh, go low, I won't pay, then he is bad debt. My customer has not told this to me. Looking at my customer's haircut, looking at my customer's shirt, looking at my customer's attitude, looking at my customer's personality, I am somewhere feeling like ಯಾಕೋ ಈ ಪಾರ್ಟಿ ಕೊಡೋದಿಲ್ಲ ದುಡ್ಡು ಅನ್ನಿಸ್ತಾ ಇದೆ. I am somewhere having some doubt that this customer will become a bad debt in the later times. I'm feeling it. Feelings are coming from inside. Then what do I do? Can I ignore my feelings? No. Some feelings are very valid. Conservatism says if you have a feeling that it will become expense in the future, record it today. Don't wait for the future date. What does conservatism say? If you have a feeling that it will become a bad debt in the future, record it today. So, provision for bad debt is created. Provision for bad debt is created for expected bad debt, not actual bad debt. It is expected bad debt, but not actual bad debt. Why is it created? Created on the basis of conservatism. What is the reason why we create it? On the basis of conservatism. And this provision for bad debt is an estimate. We'll discuss it later. Right now, character introduction is done. Sundry debtor, customer to whom you sold the goods on credit. Bad debt, expense, because our customer has failed to pay us money. Provision for bad debt. They have not told that they will not pay. I'm expecting that they will not pay. So I create provision. And this provision, when it is created, it's an expense. But once created, it's a liability. When you create it, it's an expense. But once created, it's a liability. Did you all understand this? Let's proceed. Accounting entries for bad debt. What is the accounting entry that should pass for bad debt? Bad debt is an expense. Whenever we call it an expense, we need to debit it. We need to, and this bad debt will decrease our debtors. Let's say my debtors is 1 lakh. Now, when I say 10,000 is bad debt, I won't recover 10,000 from my debtor. Am I right? So, my debtor will reduce from 1 lakh to 90 because one debtor of 10,000 told you won't pay money. So, bad debt is an expense. Bad debt debit. Bad debt will reduce our debtors. Debtors credit. Bad debt is an expense. Bad debt debit. Bad debt will reduce our asset. So debtors credit. I hope everybody understood. And bad debt account at the end of the year is a nominal account. All nominal accounts at the end of the year should be closed by transfer to P&L. All nominal accounts should be closed at the end of the year by transfer to P&L. What do I do? This bad debt will be credited, decrease in expense, and debit will be given to profit and loss account. This is the accounting entry that I should pass for bad debt. This is the accounting entry that I should pass for bad debt. Did everybody get this? Very nice. So this is an expense. Bad debt as an expense, it's increasing. I debit it. But bad debt is decreasing the value of our asset. You will credit it. And this bad debt, when I transfer to my PL, expense is decreasing. So I credit it. I hope you all understood this entry. Now, bad debt will appear in trial balance. If bad debt is appearing in trial balance, what does that mean? That means this first journal entry is already passed. They have already passed the journal entry bad debt account debit to debtors. They have deducted from debtors. Bad debt ledger is getting closed. It has come to trial balance, meaning deduction from debtors, meaning this entry is already done. That's the reason when bad debt appears in trial balance, we don't deduct it from debtors. Why is it that we don't deduct? Don't tell something coming in trial balance should be written once, something coming in adjustment should be written twice. Please don't give this nonsense answer. The answer is it is already deducted from debtors. That is the reason it's appearing in trial balance. Journal entry is passed, bad debt to debtors. Debtors has reduced, bad debt is been debit balance. The ledger gets closed. It appears in trial balance on the debit side. So already deducted from debtors in final accounts, we don't have to deduct it freshly. Further, we have to write it in P&L account debit side. We have to write it in P&L account. However, if bad debts appear in adjustment, that is, it is not appearing in trial balance. You know what does that mean? We have not passed the first entry. We have not passed the first entry. We should not do two impact. We should do journal entry. What is the entry that we should do? Bad debt to debtors. Then P&L to bad debts. Here there is bad debts debit. Here there is bad debt credit. Basically that will get eliminated. That's a temporary nominally account. But what is the impact that we should give? We have to reduce it from our debtors. We also need to write it in our P&L as an expense. Whenever bad debt is not appearing in trial balance and it is given as an adjustment, we have to deduct it from debtors also. We have to write it to P&L account also. We'll do a quick recap of what we just discussed. The summary of the entire discussion with regard to bad debts is bad debt is an expense. Bad debt is an it is that part of debtors what we are not going to receive. If the bad debt appears in trial balance, should we deduct it from debtors? No. Should we write in P&L? Yes. What if bad debt appears in not in trial balance but in adjustment? We should deduct it from debtors and transfer it to P&L. We should deduct it from debtors and transfer it to P&L. We have to do both of them. Did you get it? The next character in the house is provision for bad debts. Like I mentioned before, bad debt is when a customer says that he will not pay money. On the other hand, in the case of provision for bad debt, customer has not told that he will not pay, but you have started thinking that the customer might not pay, and that might not pay in the future will result in loss in the future. But conservatism says, hey, don't wait till future, record it now only. So we create provision. Provision for bad debt is an expense when created, it's liability after creation. Any provision for that matter, when you create it, it's an expense. Once you create it, it's a liability. Very important statement. Remember this rule. When you create provision, it is an expense. Once you create provision, it is a liability. What is a journal entry for provision? It is an expense, no? In P&L account, I will write on the debit side to provision for bad debts. This is increase in expense, increase in liability. This is increase in expense and increase in liability. I don't need this. What will be narration when I create it? Same narration. Being provision created. Being provision created. Again, this provision, sometimes in your exam questions, it comes in trial balance. Sometimes it doesn't come in trial balance. Sometimes it comes in trial balance. Sometimes it doesn't come in trial balance. Whenever it doesn't come in trial balance, after the trial balance is prepared, below that they'll mention provision. How to deal with this? We'll learn. Whenever they give provision for bad debts in trial balance, it means provision is already created. Already this journal entry is passed. There is no need for me to pass this entry, meaning I don't have to write such provision in P&L account. However, when they give provision in other than trial balance, that is in adjustment, when the trial balance doesn't include provision, provision is given in adjustment. You know what does it mean? Provision is not yet created. They're asking you to create provision. When you create provision, you would have to record the expense. So, when the provision appears in trial balance, don't write it in P&L. When the provision does not appear in trial balance but it is given in adjustment, we have to write it in P&L. And in both the cases, once you create it, provision is a liability. But I have to write it on the liability side. But I've written it with a strike through. Why? It is a liability. On what? It is a provision created on debtors. If you see your balance sheet, on the liability side there is provision, on the asset side there is sundry debtors. Both of them belong to same family. So debtors will say, hey, why do you have to stay on the other side? Why do you pay extra rent? Come, let's live together. So provision for doubtful debts, which is recorded on the liability side, for the sake of presentation in the balance sheet, will be shifted to asset side. Liability side, it's positive. When it is shifted to asset, it becomes negative. So we deduct it from our asset and write the asset as a negative amount. For instance, if the debtor is 1 lakh, provision is 10,000. If we create it, we'll write it in P&L account debit side and balance sheet liability. If it is already created, it would appear in trial balance. I'll straight away take it to balance sheet liability side. I'll write 10,000. But just before we close our balance sheet, debtors is 1 lakh on the asset side. Provision for bad debts is 10,000 on the liability side. We shift this 10,000 provision for bad debts from liability side to asset side. And from debtors of 1 lakh, we will deduct 10,000 provision for bad debts and record our debtors as 90 in that balance sheet. Having said this, is my debtors 1 lakh or 90? 1 lakh. And 10,000 is provision. Only in that balance sheet it looks like it is 90. For next year, debtors is not 90. Debtors is 1 lakh, provision is 10. So there is no journal entry transferring provision to debtors. Provision is a liability, debtor is an asset. But for the sake of presentation in the balance sheet, we write them on the same side, debtors minus provision. I hope you understood. It is not to be written on the liability side. We would have to deduct it from the asset, which is debtors. We have to deduct it from the asset, which is debtors. Now, when a customer says he would not pay money, when a customer says he would not pay money, I know this customer owes me rupees 10,000, he wouldn't pay 10,000. If no customer has individually told that he will not pay, if I have to start thinking that one customer will not pay, there is another question mark. How much will he not pay? So, provision for doubtful debts is an estimate. There is no specific amount assigned to it. Valuation principles fail. You know what is an estimate? It is a number that we come across based on our past experience and present situation. In the past, out of the sales that we have made, 2% of people turned out to be bad. For every 100 customers I met, or for every 100 rupees that I'm supposed to receive, 2 rupees I did not receive. That's my past experience. So I will decide that 2% of my debtors will be bad, estimated. And 2% on what? On the this year's debtors. Let's say this year's debtors is 50,000. On 50,000, I'll apply 2%. Past estimate, 2% of people won't pay. Present situation, closing debtors of 50. On that, I'll apply 2%. I'll compute provision. So provision is an accounting estimate. Provision is an usually created as a percentage of debtors. When I say percentage of debtors, it is past estimate. and computed on the current year closing debtors. Computed on the current year closing debtors. That means it is past estimate based on present situation. That is what is making it an accounting estimate. Remember to apply provision percentage on the closing debtors after deducting actual bad debts for that period. Now, when I say 2% of people won't pay, first delete those people they've not who told that they will not pay. Only after you eliminate them, balance of debtors on that only you can apply 2%. For example, there are total debtors of 100. In the total debtors of 100, 10 rupees, it's bad. They only told bad. Eliminate 10 from 100. We'll get 90. 90 is good. 90 is among the good you are expecting someone to not pay. So first eliminate the bad debts, identify the good debtors, and then in the good debtors you identify who can become bad. Don't apply percentage on the total debtors. Apply percentage after deducting our bad debts which are actual. I hope everybody understood. Whenever we apply this percentage on the closing debtors, let's say they want us to maintain 2% on debtors as provision. I have 50,000 rupees debtors after deducting bad debts. On that I applied 2%. Take 50,000 into 2%. 2,500. 2,500 is the extent to which I have to maintain provision. 2,500 is the extent to which I have to maintain provision. What if there is already provision existing? The treatment is different. What if there is no provision in trial balance? The treatment is different. If there is no provision existing in trial balance, then full amount, whatever I told, I'll create provision for it. Full amount, whatever I just mentioned, for that extent I create provision. However, if in case there is an existing provision, now when you apply 2% on 50,000, it came to 2,500. 50,000 into 2% is 1,000. Very good, very good. Beautiful answer. Maintain that for next time also. On 50,000, when you apply 2%, you got 1,000 rupees. On this 1,000 is the provision that I'm supposed to maintain. How much is the provision that I'm supposed to maintain? If in case there is already some provision existing, we need to compare this with that. We need to compare this, the provision that I just identified with that. If the existing provision is less, let's say we already have provision of 800, provision to be maintained is 1,000. So we already have created provision of 800. We don't have to create that 800 provision. It is there from last year. We have to make this 800 provision 1,000. How do we make this 800 rupees of provision 1,000? We additionally create provision of 200. Create provision for the difference. However, in an alternate scenario, if the existing provision is more than the provision to be created, meaning already in the trial balance there is provision of 1,200, but on 50,000 debtors when you applied 2%, you came across 1,000 as the provision. How much is the provision already maintained? 1,200. How much is the provision to be maintained as 2% of 50,000? 1,000. We have excess provision of 200. This 1,200 should be brought down to 1,000. So that excess provision should be written off. Excess provision should be create provision. You know what is the accounting entry? What is the entry to create provision? It's an expense. Provision account debit, sorry, P&L account debit to provision. When you create it, it's an expense. Once you create it, it becomes liability. However, when the existing provision is more than the provision to be maintained, we have excess provision already created. Such excess provision has to be written off. To write off that excess provision, what do? We will reverse the entry that we have done in the past. What is the entry that we did here? P&L to provision, that is to create. If you have to reverse the provision, entry will be provision to P&L. Or another logic to this is creation of provision has made it a liability. When I reverse it, liability has to reduce. Because the liability has to reduce, I will debit provision for doubtful debts or bad debts. And when I reduce my liability, that will turn into profit. So profit will be credited. I hope everybody understood this. The next party in the family is recovery of bad debts. What is recovery of bad debts? This is a very interesting candidate. A customer told us that he will not pay money. We told him, hey, if you don't pay money, you know what will I do? Yes, what will you do? I'll write bad debts entry and I wrote bad debts entry. That's it. Not rowdy here, okay? I can't do anything. I wrote one bad debt entry. He went home, I came home, I am upset. Shit. Why? I sold goods and I did not receive money against it. To me, it is bad debts. Decrease in my debtors. Goods went free. It's an expense, leading to loss. My debtor went home. He slept peacefully. Ah, I got goods free. I bought goods and he told I'll not pay money also. And he slept. He started dreaming. In his dream, God showed up. God told, hey, you're a bad guy. That supplier of yours, Rajvardhan, is a good boy. You bought goods from him. You pay him money. Why did you cheat? Tomorrow morning, the moment you wake up, go pay the money that you owe him. If not, when you come, I'll keep the oil hot for you in the hell. Then he woke up in his dream. What happened? God told me to pay. Then next morning wakes up, pays, prays to God, takes all the money that he has, comes to me, and then he pays money. He'll be like, what happened? Then like, "No, that's a big story, you won't understand." Like, okay, fine, give me money. I took money now. This is recovery of bad debt. The debtor who told he will not pay money and I've already written off as bad debt has now paid me money. When he pays me money, I will debit bank account. I will debit. Don't credit debtors. Debtors is not decreasing. Already debtors has decreased. Out of 1 lakh rupees debtors, I've written off 10,000 as bad debts. My debtors has become 90. Now this 10,000 rupees debtor is giving me money. If you credit it to debtors, debtors will become 80. Is debtors decreasing? No, debtors will remain same. That money, when he told he will not give, I wrote as expense. Now that I have received, I should write it as income. Bad debts recovered. Bank balance will increase, asset increase. And income increase. Asset increase, debit, income increase, credit. Asset increase, debit, income increase, credit. Ta-da! And this bad debt recovered being income, this bad debt recovered being nominal in nature, I will debit bad debt recovered account, crediting my P&L account. This is the accounting entry that I should pass to transfer bad debt recovered to P&L. If bad debt recovered is appearing in trial balance, meaning this entry is already passed, I would have to write that bad debt recovered only in my P&L account credit side. I'll repeat, if bad debt recovered is appearing in trial balance, it's already received, bank balance is already increased, it is income, I'll post it to P&L account credit side. However, if bad debt recovered is given in adjustment, bad debt recovered is given in, add it to bank balance and then post it to P&L account credit side. I hope you all understood. This is the treatment of sundry debtor, bad debt, provision for bad debt, and bad debt recovered. If in case the question mentions anything like provision for discount, that is treated exactly like how you treat provision for bad debt. Provision for discount is same like provision for bad debt. But the order is first debtors, actual bad debts, provision for bad debt. After provision for bad debt, create provision for discount. Provision for discount as a percentage is computed on debtors after deducting bad debts and provision for bad debts. This is the discussion on debtors, bad debts, and provision for bad debts. We'll discuss questions next time. Okay.